There is a single fatal flaw that can turn the most brilliant investment into a catastrophic loss. It's not a market crash, not a disruptive technology, not a recession. It's a flaw in human character. You can find a company with a dominant market position, a fortress balance sheet, and a product that customers adore. But if you hand your capital to the wrong people, you are building your financial house on a foundation of sand. The numbers will tell you a story of past success, but character is the only reliable prophet of future behavior. Warren Buffett, the most successful investor in history, has built a multi-hundred-billion-dollar empire on a bedrock principle that most of the market ignores. It is a rule so simple it sounds almost naive, yet so powerful it has acted as an impenetrable shield for his portfolio for over 60 years. The principle is this: you cannot make a good deal with a bad person. It's not that it's difficult, it's not that it's risky, it is impossible. This isn't a moral judgment from an old man in Omaha. It is the single most important piece of financial analysis you will ever learn. It is the core of a risk management strategy so effective that it eliminates the biggest threats to your wealth before they ever have a chance to materialize. What we are about to explore is not just another stock-picking tip. It is a complete re-engineering of your investment philosophy, a shift from chasing fleeting numbers on a screen to forging lasting partnerships with people of integrity. This is the final promise that can protect everything you work for. It's the one character trait that shields your entire portfolio. The journey to understanding this profound truth begins not with a grand success, but with a stinging, multi-billion-dollar failure. It's a story about a seemingly wonderful business that became one of Warren Buffett's biggest admitted mistakes, not because of a bad product or a weak market, but because it forced him to confront a subtle but devastating form of untrustworthiness, the failure of intellectual honesty in the face of a changing world. In 1993, Berkshire Hathaway acquired Dexter Shoe Company. On the surface, it was a classic Buffett investment. Dexter was a durable, American institution based in Maine, manufacturing rugged, high-quality shoes. It had a strong brand, consistent profitability, and a long history of success. It seemed to possess what Buffett calls a durable competitive advantage, or a moat. He was so confident in the business and its future that he did something he rarely does. He paid for the acquisition not with cash, but with Berkshire Hathaway stock. He traded 203 shares of his own company, worth about $433 million at the time, for Dexter Shoe. This was the ultimate vote of confidence. He wasn't just buying Dexter, he was making its owners, the Alphond family, partners in everything else Berkshire owned. He believed he was trading a piece of his masterpiece for an equally valuable, enduring asset. The problem was, the world was changing in a way that neither Buffett nor Dexter's management fully appreciated. The moat that looked so wide and deep was, in reality, evaporating under the heat of global competition. Low-cost foreign manufacturers began to flood the market with shoes that, while perhaps not of the same quality as Dexter's, were dramatically cheaper. The American consumer, increasingly price-conscious, began to shift their allegiance. Dexter's competitive advantage was not based on a unique brand or proprietary technology, but on efficient American manufacturing. When the cost equation of manufacturing shifted overseas, that advantage vanished almost overnight. The management team at Dexter, who had built the company into a titan, were good, honest people. They weren't crooks, they weren't lazy, but they lacked the crucial intellectual honesty to confront the brutal new reality. They were rooted in the success of the past, unable or unwilling to see that the formula that had worked for decades was now broken. They continued to operate as they always had, believing in the strength of their brand and the quality of their product, while the financial ground crumbled beneath them. The business went into a steady, irreversible decline, profits evaporated, and eventually, the business was worthless. Buffett would later write in his shareholder letter, with characteristic bluntness, "I have made no worse mistake than Dexter." The direct financial loss was the $433 million he paid, but the true cost was astronomical. Those 203 shares of Berkshire Hathaway stock that he traded away would, over the next couple of decades, become worth billions upon billions of dollars. As of today, that stake would be valued at over $15 billion. He had traded a portion of one of the greatest compounding machines in history for a business that was destined for obsolescence. The mistake wasn't in buying a shoe company. The mistake was in misjudging the ability of its management to navigate the future. He thought he was partnering with people who could defend the castle, but he had partnered with leaders who couldn't see the invaders already scaling the walls. This experience seared a lesson into his mind. A business is only as good as the people running it. Even if they are honest in their accounting and decent in their personal lives, if they lack the intellectual integrity to face unpleasant facts and adapt, they are, from an investor's perspective, just as dangerous as a common thief. They will preside over the slow, or sometimes rapid, destruction of shareholder value. This refined his first principle. It wasn't just about avoiding outright crooks. It was about exclusively partnering with people who possessed a fierce combination of operational talent, shareholder-friendly alignment, and, most critically, unwavering intellectual honesty. This became his integrity filter, the non-negotiable first principle of his entire investment strategy. The psychological principle that makes this filter so necessary is what behavioral scientists call the slippery slope of ethical compromise, combined with a phenomenon known as bounded ethicality. No CEO of a major corporation wakes up one morning and decides to commit massive fraud. It doesn't happen that way. Instead, it begins with a tiny step onto a very slippery slope. It starts with a desire to meet quarterly earnings expectations. Perhaps the company is just a few $1,000,000 short. So management decides to pull a little bit of revenue from next quarter into this one, a practice known as channel stuffing. They offer their distributors a steep discount to buy more product now than they actually need. The books look great for the quarter, the stock price goes up, and everyone gets their bonus. It seems harmless, a victimless bit of accounting magic. But now they have created a hole in the next quarter. To fill that hole, they have to pull even more revenue forward. The small, one-time compromise becomes a habit. The next step might be to reclassify certain operating expenses as capital investments, further inflating current profits. Each step down the slope seems small and justifiable in isolation. This is bounded ethicality in action. People are psychologically constrained from seeing the full ethical implications of their actions. They convince themselves that what they are doing is not really wrong. It's just aggressive accounting, or managing earnings, or standard industry practice. They are not bad people in their own minds. They are just trying to keep the company successful. But with each step, the line between aggressive accounting and outright fraud becomes blurrier. Eventually, they are running a criminal enterprise, but they slid into it so gradually they can't even recognize it themselves. Buffett's integrity filter is designed to avoid any company that shows even the slightest sign of being on that slope. He's not trying to guess how far down they'll slide. He simply refuses to get on the ride. He understands that a culture that tolerates small intellectual dishonesties is a breeding ground for catastrophic ones. To put this into practice, we can use a powerful mental model, the three buckets approach to vetting any investment, a core part of Buffett's investment strategy. Imagine three sequential buckets you must fill before you can make an investment. Bucket 1 is the business. Inside this bucket are all the questions about the company itself. Is it a wonderful business? Do I understand how it makes money? Does it have a durable competitive advantage? A strong moat? Is it in an industry with favorable long-term prospects? Most diligent investors spend a lot of time here, and they should. Bucket 3 is the price. This is where valuation comes in. Is the business available at a fair or even wonderful price? Can I buy it with a margin of safety? This is the domain of financial analysis, discounted cash flows, and comparing price-to-earnings ratios. The vast majority of investors, both amateur and professional, make a critical, often fatal, mistake. They do their homework on Bucket 1, determine it's a great business, and then immediately jump to Bucket 3 to see if the price is right. They completely leapfrog the most important bucket of all. Bucket 2 is management. This bucket contains the questions that the Dexter Shoe story taught us are paramount. Is the company run by able and honest people? Do they have a track record of integrity? Do they think like owners and act in the best interests of shareholders? Are they intellectually honest about the challenges the business faces? The blueprint is simple, but non-negotiable. You must fill the buckets in order. You are not allowed to even consider the price in bucket 3 until you have given a resounding, unequivocal yes to the questions in bucket 2. If there is any doubt, any hesitation, any red flag about the integrity or ability of management, the process stops. The investment is rejected, regardless of how wonderful the business seems or how cheap the stock is. This single discipline, this refusal to skip bucket 2, acts as a powerful shield for your entire portfolio. It forces you to say no to 99% of what's out there, but the 1% you say yes to will be built on a foundation of rock. The antithesis of this disciplined approach is what we can call the path of the 99%, or the story stock trap. This is where most market participants live, and it's why most of them underperform over the long term. The trap is baited with a seductive narrative. Imagine a new technology company, let's call it InnovateX, with a visionary, charismatic CEO. This CEO is on the cover of magazines, gives inspiring talks about changing the world, and projects an aura of unstoppable genius. The company's stock is soaring, doubling and then doubling again. The story is that InnovateX has a revolutionary new product that will disrupt an entire industry. Everyone who gets in now is on the ground floor of the next Google or Amazon. Investors on this path get swept up in the narrative. They don't check bucket 2. In fact, they mistake the CEO's charisma for integrity. They see the rising stock price as proof that the story is true. They ignore the warning signs. They don't notice that the CEO is compensating himself with an obscene amount of stock options, diluting the value for existing shareholders. They don't investigate the fact that InnovateX is buying its raw materials from another company that is secretly owned by the CEO's brother-in-law at inflated prices. This is a classic related party transaction, a huge red flag for poor corporate governance. They don't read the footnotes in the annual report, where the company admits it's using aggressive revenue recognition policies. All they see is the story and the rising stock price. For a while it works. The stock keeps going up, reinforcing their decision. But the business itself is a house of cards. One day, a critical news report comes out, or an analyst digs into the accounting, or the company simply can't sustain the illusion anymore. The story shatters. The stock collapses 90% in a week. The charismatic CEO resigns in disgrace. The investors who fell for the story are wiped out, left wondering what happened. What happened was simple. They made a deal with a bad person. They chose a compelling story over verifiable integrity. They skipped bucket 2. This is not a rare occurrence. It is the repeating cycle of boom and bust in the market, a trap that has snared investors for centuries, from the South Sea bubble to the dot-com crash to the latest speculative frenzy. The direct financial connection between management integrity and shareholder value is not just about avoiding fraud. It manifests directly in the financial statements long before any scandal breaks, if you know where to look. The key is to understand that a lack of integrity almost always travels hand in hand with a desire to manipulate appearances, and the primary place this manipulation occurs is in the income statement. A management team focused on short-term stock performance rather than long-term business value will often resort to what is called aggressive accounting. Let's take revenue recognition. An honest management team recognizes revenue when a product is sold and delivered to the end customer, and payment is reasonably assured. An aggressive management team might recognize revenue the moment a product is shipped to a distributor's warehouse, even if that distributor has the right to return it and hasn't paid yet. This inflates revenue and earnings today at the expense of tomorrow. Another classic example is capitalizing expenses. Normal operating expenses like marketing or research and development are supposed to be deducted from revenue in the period they occur. This reduces net income. A management team with low integrity might decide to classify some of these costs as investments, putting them on the balance sheet as an asset and spreading the expense out over many years. This little accounting trick provides an immediate, artificial boost to reported profits. On a surface-level financial analysis, the company looks more profitable than it really is. Its price-to-earnings ratio looks cheaper. But it's an illusion. These manipulations are a ticking time bomb hidden within the company's books. Eventually, the capitalized costs must be written off, or the stuffed channels run dry. When that happens, the collapse in reported earnings is sudden and severe. By making the integrity filter your first screen, by focusing on management character before all else, you avoid the companies playing these games. You gravitate towards businesses whose financial statements are clean, conservative, and transparent, because they are run by people who believe in telling the truth. This isn't just about ethics. It's a superior form of financial analysis that protects your capital from the hidden risks that numbers alone will never reveal. The ultimate test of a principle is not how it performs in calm seas, but how it holds up in a raging storm. For Warren Buffett, that storm arrived in August of 1991 in the form of the Salomon Brothers crisis. It was a scandal that threatened to bring down one of the most powerful firms on Wall Street and inflict a devastating blow on Berkshire Hathaway, which was Salomon's largest shareholder with a $700 million preferred stock investment. This was not a theoretical exercise. It was a trial by fire that would cement his reputation and demonstrate, on the world stage, the non-negotiable importance of management integrity. The story is a masterclass in risk management, capital preservation, and what it truly means to take responsibility when everything is on the line. The crisis began with a rogue trader, a man named Paul Moser, the head of Salomon's government bond trading desk, had been systematically violating the rules of U.S. Treasury auctions. At the time, no single firm was allowed to bid for more than 35% of the bonds in a given auction. To get around this rule, Moser had been submitting illegal, unauthorized bids in the names of Salomon's clients. He was cornering the market, giving his desk an unfair advantage and generating massive profits. This was not just bending the rules, it was a felony. The problem escalated from a single employee's crime to a corporate catastrophe because of the failure of management. Salomon's top leaders, including its hard-charging CEO John Gutfreund, learned about Moser's illegal bids in April of 1991. They confronted him, and he confessed. But then, they did nothing. They didn't fire him. They didn't report his actions to the authorities. They buried the problem, hoping it would go away. This was the critical failure of integrity at the very top. For months, the secret festered within the firm's executive suite. But secrets like that rarely stay buried on Wall Street. By August, the government investigators were closing in, the story broke in the press, and all hell broke loose. The market was thrown into chaos. Salomon Brothers wasn't just any investment bank. It was a primary dealer of U.S. government debt, a crucial cog in the machinery of the global financial system. The U.S. Treasury, furious at the deception, threatened to ban Salomon from bidding in Treasury auctions. This would have been a death sentence for the firm. It would trigger a run on the bank as clients and lenders pulled their money, leading to a collapse within days. Buffett's $700 million investment, and much more importantly, the stability of the financial system, was hanging by a thread. On a Sunday morning, a desperate John Gutfreund called Buffett in Omaha. After a tense board meeting, Gutfreund and the other top executives were forced to resign. The board asked Buffett to step in as interim chairman to save the firm. He was 60 years old, had no desire to run a Wall Street firm, but he knew that if he didn't, his investment would be worthless and the fallout would be immense. He agreed. He flew to New York that day and walked into a maelstrom. His first act was to go to Washington and meet with Treasury Secretary Nicholas Brady. He had to convince the government not to deliver the death penalty. He was brutally honest. He admitted the firm's wrongdoing and laid out his plan to clean house. He made a personal plea, staking his own immense reputation on his ability to reform the firm's culture from the top down. His credibility, built over a lifetime of fair dealing, was the only asset Salomon had left. It was just enough. The Treasury granted a temporary reprieve. But the real work was just beginning. Buffett had to address the thousands of terrified Solomon employees. In his first message to them, he laid down the law with a statement that has since become one of the most famous in business history. He said, "Lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I will be ruthless." This was the integrity filter articulated as a command. He was drawing an unmistakable line in the sand. Profit was secondary. Reputation and integrity were everything. He spent months at Solomon's headquarters, cooperating fully with investigators, installing new compliance systems, and changing the compensation structure to reward responsible behavior, not just reckless risk-taking. He saved the firm from collapse, protected his investment, and in doing so, provided the world with the most powerful possible case study on why you can't make a good deal with a bad person, or in this case, a good firm with a rotten culture at its core. The Solomon crisis is a textbook example of two powerful and dangerous psychological principles: groupthink and pluralistic ignorance. These cognitive biases explain how a room full of smart, successful, and not inherently evil people, like the leadership at Solomon, could allow such a disaster to unfold. Groupthink is the tendency for a highly cohesive group to demand conformity, leading to a deterioration of mental efficiency, reality testing, and moral judgment. At Solomon, the culture was aggressive, tribal, and intensely focused on short-term profits. John Gutfreund was a powerful, intimidating leader. In that environment, questioning the actions of a star trader like Paul Moser, who was making the firm a fortune, was a career-limiting move. It was easier for everyone to look the other way, to rationalize that what he was doing was just sharp-elbowed trading, not a federal crime. The desire for consensus and harmony within the group overrode the individual's critical judgment. Pluralistic ignorance is a related and equally insidious phenomenon. It describes a situation where a majority of group members privately reject a norm but go along with it because they incorrectly assume that most others accept it. On the Solomon trading floor, many traders likely knew or suspected that Moser's bids were improper, but each individual looked around and saw nobody else speaking up. They concluded, if no one else is concerned, it must be okay. I must be the crazy one. This creates a spiral of silence. The collective illusion of consensus is maintained because no single person is willing to be the first to break it. The combination of groupthink and pluralistic ignorance created a cultural rot at Solomon. It wasn't that everyone was a criminal. It was that the system suppressed the moral courage of the individuals within it. Buffett's immediate and ruthless intervention was designed to shatter that system. His "lose reputation and I will be ruthless" memo was a direct assault on pluralistic ignorance, making it clear that the new norm was absolute integrity and that silence in the face of wrongdoing would no longer be tolerated. From this crisis, Buffett institutionalized a mental model that is both profoundly simple and incredibly effective for maintaining ethical standards in any organization, from a Wall Street bank to a small family business. It's called the newspaper test. When Buffett took over Solomon, he told his employees, "I want employees to ask themselves whether they are willing to have any contemplated act appear the next day on the front page of their local paper, to be read by their spouses, children, and friends, with the reporting done by an informed and critical reporter." This is not a complex legal or ethical treatise. It is a gut check. It's a practical thought experiment that any person can apply to any decision in seconds. Let's break down the blueprint. Step 1. Contemplate the action. Don't just do it on autopilot. Pause and consider the decision, whether it's a major strategic choice or a small daily task. Step 2. Visualize the front page. Don't just think about it abstractly. Picture the headline, the photograph, your name in print. Make it visceral. Step 3. Imagine your inner circle reading it. Your spouse, your children, your parents, your closest friends. These are the people whose respect you value most. How would they feel? Would you be proud, or would you be ashamed? Step 4. Add the critical reporter. Assume the story will be written by someone who is smart, skeptical, and has done their homework. You won't be able to spin your way out of it with clever corporate jargon. The underlying truth of the action will be laid bare. If the action passes this test, you can proceed with confidence. If it fails or even makes you hesitate, you must stop immediately. It's an unacceptable risk. This mental model is a powerful tool for entrepreneurs and leaders. It transforms ethics from a vague, philosophical concept into a tangible, emotional decision-making framework. It's a key part of building a CEO mindset focused on long-term sustainability because it prioritizes the one asset that, once lost, can never be fully recovered: reputation. The path of the 99% stands in stark contrast to Buffett's handling of the Solomon crisis. The standard corporate response to scandal is what we can call the fine is just the cost of doing business mentality. This playbook is depressingly common. When a company is caught in a major ethical or legal breach, the first step is to deny and minimize. Public relations teams issue carefully worded statements that admit no wrongdoing but promise to, quote, take the matter seriously. The second step is to delay and obstruct. The company uses its army of lawyers to fight investigators at every turn, burying them in paperwork and dragging out the process for years. The goal is not to find the truth, but to wear down the opposition. The third step is to deflect and sacrifice. The company identifies a few mid-level or low-level employees, declares them to be a few bad apples, fires them publicly, and claims the problem has been solved. This is done to protect senior management from any real accountability. The final step is to negotiate a settlement. The company agrees to pay a large fine to the government, without admitting or denying guilt. From the company's perspective, this fine is not a punishment. It is simply a line-item expense, a cost of doing business. We saw this playbook run for years in the Wells Fargo account fraud scandal. Millions of fake accounts were created by employees under intense pressure to meet impossible sales quotas. The initial response from management was to blame a few thousand low-level bank tellers, while the executives who designed the system that incentivized the fraud kept their jobs and their bonuses for years. This approach demonstrates a complete lack of genuine ownership and integrity. It treats the symptoms, not the disease. The result is a profound and lasting destruction of trust with customers, employees, and investors. The stock stagnates for a decade, and the brand is permanently tarnished. Buffett's approach at Solomon was the polar opposite. He immediately admitted fault, took personal responsibility, cooperated fully, and focused on fixing the root cause, the corporate culture. He understood that integrity is not a cost center. It is the bedrock of all long-term shareholder value. The direct financial connection here is the crucial but often overlooked concept of reputational risk. This is the risk of damage to a company's name and public image. Reputational risk is a massive, off-balance sheet liability that you will never find in a standard financial analysis. There's no line item for it, no ratio to calculate it. But when it crystallizes, it can be more destructive to shareholder value than any amount of debt or any operational failure. In the case of Salomon Brothers, the reputational damage was so severe it threatened to impose the, quote, corporate death penalty. If the Treasury had banned them from the auctions, the firm's business model would cease to exist overnight. All of its equity, billions of dollars of shareholder value, would have been wiped out in an instant. This is the ultimate failure of capital preservation. Even when the consequences aren't that extreme, the financial costs are staggering. A company with a damaged reputation faces a host of tangible economic headwinds. Customers are less likely to buy its products. The most talented employees will leave for competitors they can be proud to work for. Regulators will scrutinize its every move, increasing compliance costs. Lenders will charge it higher interest rates to compensate for the added risk. Its stock will trade at a permanent discount to its peers because investors will no longer trust the numbers or the people producing them. By making management integrity a cornerstone of your investment strategy, you are actively managing this enormous hidden risk. You are investing in companies that are less likely to suffer these catastrophic value-destroying events. You are practicing a deeper, more resilient form of portfolio protection, safeguarding your wealth from the kind of disasters that blindside investors who only look at the numbers. It is one of the great paradoxes of investing that we, as human beings, are remarkably susceptible to the very people most likely to harm us financially. We are wired to trust the untrustworthy, to be seduced by charisma, and to overlook the glaring red flags of deception. To protect ourselves, we must first understand the deep psychological currents that pull us toward bad actors. There is perhaps no more illustrative and cautionary tale in modern financial history than that of Crazy Eddie Antar, a story that perfectly demonstrates how a charismatic personality and a compelling growth story can create a mass hallucination, convincing thousands of investors to pour their money into a complete and utter fraud. In the 1970s and 80s, Crazy Eddie was an iconic consumer electronics chain in the New York metropolitan area. Its television commercials were legendary. A hyperactive pitchman, Jerry Carroll, would scream at the camera, flail his arms, and declare that Crazy Eddie's prices were insane. The ads were obnoxious, unforgettable, and wildly effective. They built Crazy Eddie into a household name and fueled its rapid expansion. The company went public in 1984, and Wall Street fell in love. The growth numbers were spectacular. Sales and profits seemed to march relentlessly upward, quarter after quarter, year after year. The stock was a rocket ship. Behind the insane commercials and the beautiful numbers, however, was a deeply rooted criminal enterprise run by Eddie Antar and his family. The fraud began long before the company went public. In the early days, it was a simple cash skimming operation. Family members would pocket cash from the registers before it was recorded, cheating the government out of taxes. But when they decided to take the company public, the nature of the fraud had to change. Now, the goal was not to hide income, but to inflate it as much as possible to drive the stock price higher. They began a systematic campaign of accounting fraud that was breathtaking in its scope and audacity. One of their signature moves was what they called the Panama Pump. They would take the previously skimmed cash, fly it to secret bank accounts in Panama, and then wire it back to the company, disguising it as legitimate revenue. They also engaged in massive inventory fraud. They would inflate inventory counts, book fake purchases, and create phony debit memos. In one infamous example, they included a 10-foot-high stack of empty VCR boxes in their inventory count, which the auditors from a major accounting firm somehow failed to notice. For years, the scam worked perfectly. Investors, including sophisticated institutional money managers, saw only the incredible growth story. They saw the packed stores, they heard the ubiquitous commercials, and they believed in the genius of Eddie Antar. They were making a good deal with a very bad person. The end came in 1987. After a family feud led to Eddie being ousted from the company, the new management team finally uncovered the monumental fraud. The stock, which had been a high flyer, collapsed to zero. The company filed for bankruptcy. Eddie Antar fled the country, becoming an international fugitive before eventually being caught, convicted, and sent to prison. Thousands of investors lost everything. The Crazy Eddie saga is a stark lesson. A great story and a charismatic leader can act as a powerful anesthetic, numbing the investor's critical thinking and sense of skepticism. The psychological mechanisms that made a fraud like Crazy Eddie possible are the halo effect and authority bias. These cognitive biases are powerful shortcuts our brains use to make sense of the world, but they can be easily exploited by those with bad intentions. The halo effect is our tendency to let one positive trait of a person or company color our perception of all their other traits. In the case of Crazy Eddie, the halo was created by the company's incredible sales growth and the charismatic, larger-than-life marketing persona. Because sales were so strong, investors automatically assumed everything else about the company must be strong too: its accounting, its corporate governance, its management integrity. The positive data point of growth created a glowing halo that blinded them to the deeply negative reality of fraud. They didn't dig into the details because the halo told them they didn't need to. We see this effect constantly with so-called visionary CEOs. A leader who is perceived as a genius in product development or marketing is often given a free pass on other, more critical issues like capital allocation or ethical conduct. Their brilliance in one area creates a halo that makes us assume they are brilliant in all areas. Authority bias is our tendency to attribute greater accuracy and importance to the opinion of an authority figure. We are socially conditioned from a young age to trust experts, leaders, and successful people. Eddie Antar, as the founder and CEO of a rapidly growing public company, was a significant authority figure. The major Wall Street firms that underwrote the stock and the Big 8 accounting firm that audited the books were also powerful authorities. When all these authorities signaled that Crazy Eddie was a great investment, the average person's skepticism was disarmed. It's hard to bet against the experts. The con artist's greatest tool is the manipulation of these biases. They create a powerful halo of success and wrap themselves in the symbols of authority. They understand that if they can control your perception of them, they can control your investment decisions. This is why a core part of any robust investment process must be a conscious effort to counteract these biases, to look past the halo and question authority. To systematically combat these psychological traps, we can employ one of Charlie Munger's most powerful mental models: invert, always invert. Munger, Buffett's longtime partner, famously said, "All I want to know is where I'm going to die, so I'll never go there." It's a morbidly funny way of expressing a profound truth about problem solving. Instead of asking how to achieve success, you ask what causes failure and then avoid those things. We can apply this inversion principle directly to our due diligence on management integrity. Instead of asking, "Is this management team trustworthy?" which is a vague and difficult question to answer, we invert it and ask, "If I wanted to screw the shareholders, how would I do it?" This simple flip in perspective transforms you from a passive believer into an active detective. It forces you to look for the tools of deception. This leads to a practical checklist, a blueprint for sniffing out untrustworthy management. First, you look for related party transactions. This is where the company does business with entities controlled by the executives or their families. Like Crazy Eddie buying supplies from his brother-in-law, this is one of the biggest red flags in corporate governance because it creates an obvious conflict of interest. Second, you scrutinize executive compensation. Is the CEO's pay tied to long-term sustainable metrics like return on invested capital? Or is it based on short-term stock price movements and hitting quarterly earnings targets, which incentivizes accounting games? Are they showering themselves with stock options while the underlying business value stagnates? Third, you check for frequent auditor changes. A company that switches its accounting firm every few years may be opinion shopping, looking for a more compliant auditor who will sign off on their aggressive accounting. Fourth, you read the financial reports with a skeptical eye. Are they clear, simple, and straightforward? Or are they filled with confusing jargon, endless footnotes, and non-standard financial metrics designed to obscure rather than clarify? A management team with nothing to hide writes clearly. A team playing games often hides in complexity. By actively searching for these negative signals, by trying to figure out how they could screw you, you are far more likely to spot the bad actors before they can do any damage to your portfolio. The path of the 99% is to do the exact opposite. Most investors don't invert, they extrapolate. They engage in what can be called chasing hot stocks and genius CEOs. Their process, if you can call it that, begins with a story they hear on TV, on a financial news website, or increasingly on social media. They hear about a company whose stock is on fire. They see a chart that is a straight line up and to the right. They hear about a genius CEO who is the next Steve Jobs. The fear of missing out, or FOMO, kicks in. They don't want to be the person who missed the next big thing, so they buy the stock. Their due diligence consists of confirming that the story is popular and the price is going up. They are buying the narrative, not the business. They are investing in social proof, not financial reality. This behavior reached its zenith during the dot-com bubble of the late 1990s. Companies with no revenue, no profits, and in many cases no viable business plan were IPOing and soaring to billion-dollar valuations overnight. Why? Because they had a .com in their name, and a charismatic 25-year-old CEO who could spin a good yarn about eyeballs and network effects. Investors who chased these story stocks ignored every fundamental principle of sound investing. They didn't care about management integrity. They cared about momentum. When the bubble burst in 2000, trillions of dollars of speculative wealth were annihilated. People who had quit their jobs to day trade .com stocks from their living rooms were financially ruined. They made the same mistake as the Crazy Eddie investors. They trusted a seductive story peddled by unproven and often untrustworthy promoters. They didn't realize that in the stock market, a good story is often the most expensive thing you can buy. The direct financial connection, the way to ground yourself in reality and see through the narrative, is to focus on the statement of cash flows. Of the three primary financial statements, the income statement, the balance sheet, and the statement of cash flows, the latter is the most difficult to manipulate. As the saying goes, earnings are an opinion, cash is a fact. A company's net income or profit is an accounting construct, subject to all sorts of assumptions and potential manipulations like the ones we've discussed. But cash flow from operations is different. It represents the actual cash generated by the company's core business activities during a period. A major red flag for management integrity issues is a persistent and growing divergence between reported net income and cash flow from operations. If a company consistently reports high profits but isn't actually generating much cash, it's a sign that those profits may be illusory. For example, a company using aggressive revenue recognition might book a huge sale at the end of a quarter, boosting its net income. But if the customer hasn't paid yet, no cash has come in the door. This will show up as a divergence between earnings and cash flow. To perform this financial analysis, you simply look at the last 5 or 10 years of financial data. Add up the company's total net income over that period. Then add up its total cash flow from operations. In a healthy, honest company, these two numbers should track each other fairly closely. If you find a company where cumulative net income is, say, $5 billion, but cumulative cash flow from operations is only $1 billion, alarm bells should be ringing. It's a strong indication that management is playing games with the income statement. This simple check is a powerful tool for any stock-picking process. It helps you cut through the accounting fog and the seductive narratives and focus on what's real, the cash. It's a quantitative way to verify the qualitative assessment of management's character. If the avoidance of bad people is the shield that protects your portfolio, then the active search for good people is the engine that drives its long-term growth. The principle of integrity is not just a defensive strategy. It is the foundation upon which enduring wealth is built. The positive embodiment of this idea, the perfect counterpoint to the tales of fraud and failure, can be found in a simple transaction that took place in Omaha, Nebraska in 1983. It's the story of Warren Buffett's acquisition of the Nebraska Furniture Mart from its legendary founder Rose Blumkin, better known as Mrs. B. This story reveals more about Buffett's investment philosophy than 1,000 complex valuation models. Mrs. B was a Russian immigrant who arrived in America in 1917, unable to speak a word of English. In 1937, with a $500 loan, she started a small furniture store in the basement of her husband's shop. Her business philosophy was simple and unwavering: sell cheap and tell the truth. She worked tirelessly, building her business through ferocious hard work, shrewd buying, and an absolute commitment to her customers. She became a local legend, famous for her aggressive discounting and her honest dealings. By the early 1980s, the Nebraska Furniture Mart was the largest and most profitable home furnishing store in the country, doing hundreds of millions of dollars in sales, all from a single location in Omaha. Warren Buffett had been a customer and an admirer of Mrs. B for decades. He saw firsthand the power of her business model and the cult-like loyalty she inspired in her customers. He recognized that the source of the company's incredible success was not its location or its inventory, but the character of the woman who ran it. Her integrity was the company's moat. In 1983, Buffett approached the then 89-year-old Mrs. B about buying her business. The negotiation was famously simple. He asked her how much she wanted. She named a price, around $60 million. He said, "Done." There was no army of investment bankers, no teams of lawyers arguing over fine print. Most remarkably, Buffett did not conduct an audit of the company's books. He didn't send in accountants to verify the inventory or check the receivables. He bought a $60 million company based on a 2-page contract and a handshake. When asked why he would take such a risk, Buffett's answer was simple. He said he would rather have a handshake deal with the Blumkin family than a 200-page contract with the most slippery CEO on Wall Street. He had spent years observing Mrs. B's character. He knew she was honest to the core. Her life was the audit. Her reputation was the collateral. He wasn't just buying a furniture store. He was entering into a partnership with people he trusted implicitly. The deal was a spectacular success for Berkshire Hathaway. The Nebraska Furniture Mart has gone on to generate billions of dollars in revenue and profit under Berkshire's ownership, and the Blumkin family continues to run it to this day, upholding the same principles of sell cheap and tell the truth. This story is the purest expression of Buffett's rule. He made a good deal with a good person, and the result was decades of compounding wealth and 0 sleepless nights. The psychological principle at the heart of the Mrs. B story is known as signaling theory. In economics and biology, a signal is an action taken by one party to credibly convey information about themselves to another party. The key word is credibly. Talk is cheap. Anyone can say they have integrity. Anyone can write a corporate mission statement full of platitudes about honesty and customer service. But these are not credible signals. Actions, on the other hand, are expensive and hard to fake. They are powerful signals of true character and intent. Mrs. B's entire life was a series of credible signals. Her decision to keep her prices brutally low, even when she could have charged more, was a signal to her customers that she was truly on their side. Her refusal to use deceptive advertising was a signal of her commitment to the truth. For an investor analyzing management, the key is to learn how to read these signals. The single most important set of signals management sends is through their decisions on capital allocation. What a CEO does with the company's cash tells you everything you need to know about their priorities. Does the CEO use excess cash to buy back company stock when it is trading below its intrinsic value? This is a powerful signal that they think like owners and are focused on increasing the per-share value of the business for the long term. Or does the CEO use that same cash, and worse, take on debt, to make a big, flashy, overpriced acquisition that diversifies the company into a business they know nothing about? This is often a signal of empire building and ego, a desire to run a larger company rather than a more profitable one. A management team with integrity consistently allocates capital in a rational, shareholder-friendly way. Their actions signal their character far more powerfully than their words ever could. To systematically analyze these signals, we can adopt a qualitative research technique that was championed by the legendary investor Philip Fisher and enthusiastically adopted by Buffett. It's called the scuttlebutt method. The word scuttlebutt is an old naval term for a cask of drinking water where sailors would gather and trade gossip. In investing, it means going beyond the official, sanitized information provided by the company and digging for the real story by talking to people in and around the business. This is the blueprint for conducting true character due diligence. The first step is to become an archivist of the company's own words. Go back and read the last 10 to 15 years of the company's annual reports, specifically the chairman's letter to shareholders. Is the CEO candid and straightforward? Do they talk openly about the company's problems and mistakes? Or do they only highlight the positives? Buffett's own letters are the gold standard here. He is famous for discussing his errors in painful detail. An honest CEO treats shareholders like partners and tells them the whole story, good and bad. The second step is to analyze conference call transcripts. After every quarterly earnings report, the CEO and CFO host a call with Wall Street analysts. Read these transcripts. Is management's language clear and direct? Or is it evasive and full of corporate jargon? Do they answer tough questions head-on, or do they deflect and obfuscate? The tone and substance of these calls are a powerful window into their thinking. The third and most advanced step is to talk to the ecosystem. If possible, try to talk to former employees, key customers, or major suppliers. What is the company's reputation in its own industry? Are they known as a fair partner? Or do they have a reputation for squeezing every last penny out of their suppliers? Are they a great place to work? Or do they have a revolving door of talent? The fourth step is to watch what they do with their own money. Check for insider trading records. Are senior executives consistently buying shares on the open market with their own cash? This is a strong signal of their belief in the company's future. Or are they regularly selling large blocks of stock, even as they tell the public how bright the future is? The scuttlebutt method is hard work. It takes more time than just looking at a stock chart. But it's how you move from being a speculator to being a business analyst. It's how you find the next Mrs. B. The antithesis to this deep, qualitative work is a common affliction on Wall Street known as analysis paralysis on meaningless metrics. The path of the 99% is to focus obsessively on what is precisely measurable, even if it is ultimately unimportant. Many professional and amateur investors spend hundreds of hours building incredibly detailed and complex financial models. They project revenues, expenses, and cash flows out for 10 years to the second decimal place. They debate endlessly whether the correct discount rate is 8.5% or 8.7%. They track every minute fluctuation in macroeconomic data, from the consumer price index to the latest housing starts number. They celebrate when a company beats Wall Street's quarterly earnings estimate by a single penny and panic when it misses by a penny. They have mountains of data and spreadsheets full of elegant formulas. They are drowning in information but starved of wisdom. In their quest for precision, they lose sight of what actually drives long-term value. They can tell you the company's price-to-earnings ratio to 4 decimal places, but they can't tell you if the CEO is a rational capital allocator. They can model the impact of a half-point change in interest rates on the company's valuation, but they have no idea if the company's culture encourages honesty or corner-cutting. They focus on the trivial many and ignore the critical few. As Buffett has said, it's better to be approximately right than precisely wrong. The scuttlebutt method of assessing management integrity is about being approximately right on the most important variable. The obsession with meaningless metrics is a recipe for being precisely wrong about everything. The direct financial connection between trustworthy management and long-term returns can be seen most clearly in a single powerful metric, return on invested capital, or ROIC. ROIC measures how efficiently a company is using its capital, both debt and equity, to generate profits. It is calculated by taking the company's net operating profit after taxes and dividing it by its total invested capital. A company that can consistently generate a high ROIC, say, above 15% year after year, is a sign of two things: a great business with a strong competitive advantage and excellent management. It is almost impossible for a company to maintain a high ROIC over a long period of time without a management team that is both highly skilled and highly aligned with shareholders. Why? Because business is dynamic and competitive. Moats are always under attack. A management team with low integrity or poor judgment will squander the company's capital on bad acquisitions, inefficient operations, or vanity projects. This will destroy capital and drive down ROIC over time. A great management team, on the other hand, acts as a faithful steward of the shareholders' capital. They only reinvest profits into projects that they believe will earn a high rate of return. They are disciplined, rational, and focused on creating sustainable value. A consistently high ROIC is the financial footprint of management integrity and skill. When you are looking for investment opportunities, don't just look for cheap stocks. Look for companies with a long track record of high returns on invested capital. This metric acts as a powerful screen, filtering your search down to a small group of elite businesses run by elite managers. It is the quantitative proof of the qualitative character you are searching for. Ultimately, the most compelling evidence for the power of this principle is not a single anecdote or a single metric, but the half-century-long history of Berkshire Hathaway itself. The entire, sprawling, multi-hundred-billion-dollar enterprise is a monument to the compounding power of trust. It is the grandest case study ever constructed on the idea of making good deals with good people and then letting the magic of compounding do its work. When Warren Buffett took control of Berkshire Hathaway in 1965, it was a failing New England textile mill. It was a terrible business in a dying industry, bleeding cash and destined for oblivion. The initial genius of Buffett was recognizing this brutal reality, an act of intellectual honesty, and beginning the process of shutting down the textile operations and reallocating the small amount of capital they generated into better businesses. His first major acquisition set the pattern for everything that would follow. He bought National Indemnity Company and Geico, two insurance companies run by outstanding managers he trusted. He bought See's Candies, a beloved West Coast chocolate maker run by the indefatigable Chuck Huggins. In each case, Buffett's approach was the same. He found a wonderful business, one with a durable competitive advantage. He verified that it was run by managers who had a passion for the business and a deep sense of integrity. And he bought it at a fair price. But then he did something that was, and still is, revolutionary in the world of corporate finance and private equity. He left them alone. He did not fire the existing management and install his own people. He did not load the companies with debt and strip their assets. He did not force them into a centralized bureaucratic corporate structure. He created a system of radical decentralization built entirely on trust. He told the managers he acquired, "Your job is to run the business. My job is to allocate the capital you send me." He trusted them to operate their businesses with the same care and prudence they would if they were the sole owners, because in most cases they had been. He trusted them to send their excess profits to him in Omaha, and they, in turn, trusted him to reinvest that capital more effectively than they could themselves. This unique culture became Berkshire's secret weapon. It made Berkshire the preferred buyer for any family-owned or founder-led business that wanted to sell. They knew that if they sold to Berkshire, their life's work would be protected, not destroyed. Their employees would be treated fairly, and their legacy would be preserved. This allowed Buffett to buy dozens of incredible businesses over the years at fair prices, without ever having to participate in a competitive auction. The Berkshire Hathaway empire, from its insurance operations to its railroad, its utilities, and its vast collection of manufacturing and retail businesses, is a network of trust. It is a living testament to the idea that the right culture and the right people are the ultimate competitive advantage. The psychological engine that drives this decentralized model is a powerful combination of reciprocity bias and what Charlie Munger calls the Lollapalooza effect. Reciprocity bias is the deeply ingrained human tendency to want to give something back when something is received. When Buffett puts his complete and unconditional trust in his managers, he is giving them a gift of immense psychological value, autonomy, respect, and a sense of partnership. This gift triggers a powerful urge in those managers to reciprocate. They feel a deep, personal obligation not to let him down. They work not just for a paycheck, but out of a fierce loyalty to the man and the culture that has entrusted them with so much. This is a far more powerful motivator than any top-down command and control system could ever be. The Lollapalooza effect is Munger's term for what happens when multiple psychological biases act in concert, in the same direction, to produce an extreme outcome. At Berkshire, you have reciprocity bias. You also have incentive-caused bias. The managers are rewarded for the long-term performance of their specific business, so their financial interests are aligned. You have authority bias. They are working for a man they admire and respect. You have social proof. They see all the other legendary managers within the Berkshire system acting with integrity and are influenced to do the same. When all of these psychological forces are pulling in the same direction, the result is not just a linear improvement in performance, it's an explosive, non-linear, Lollapalooza outcome. It creates a self-reinforcing culture of excellence and integrity that compounds on itself year after year, decade after decade. This is the soft, psychological architecture that underpins Berkshire's hard, financial success. The blueprint for applying this principle to your own long-term investing is to adopt what Buffett calls the owner earnings mindset. This requires a fundamental shift in your identity as an investor. You must stop thinking of yourself as a trader of stocks, which are little electronic blips on a screen. You must start thinking of yourself as a potential part owner of a real business. Before you buy a single share of any company, you should perform a simple thought experiment. Imagine you had enough money to buy the entire company, not just a few shares. You would own it all, and you would be stuck with the current management team to run it for you. Now ask yourself the critical question: would I be comfortable having this CEO as my business partner for the next 20 or 30 years? Would you trust them with your family's entire net worth? Would you feel confident that they would always act in your best interest, that they would tell you the truth, and that they would work as diligently to protect your capital as they would their own? If the answer is anything less than an enthusiastic yes, then you should not buy even a single share. This mindset changes everything. It forces you to elevate your analysis beyond the latest quarterly report or the stock's short-term momentum. It compels you to do the deep, scuttlebutt-style research into the character and incentives of management. It shifts your time horizon from months to decades. It transforms your investment strategy from a transactional one to a relational one. You are no longer just buying a stock, you are choosing a business partner. This is the final and most important filter for building a portfolio designed for true, multi-generational wealth management. The antithesis of this partnership mindset is the approach taken by many modern activist investors. While some activists can be a force for positive change, a significant portion of them operate with a short-term, transactional worldview that is the polar opposite of Buffett's. Their process is often a form of corporate rating dressed up in the language of shareholder value. They will buy a significant stake in a company and then publicly demand that management take immediate action to, quote, unlock value. This usually means firing people to cut costs, selling off promising but not yet profitable long-term projects, and, most importantly, leveraging up the balance sheet by taking on massive amounts of debt to finance a huge stock buyback. These actions can often create a short-term sugar high in the stock price. The activists, having made a quick profit, will then sell their stake and move on to their next target, leaving the company in a much weaker long-term position. It is now burdened with debt, stripped of its growth projects, and has a demoralized workforce. This is the ultimate transactional view of business. The company is not a living organism to be nurtured. It is a collection of assets to be chopped up and sold for the highest immediate price. This approach completely ignores the value of culture, trust, and long-term partnership. It is a philosophy that sees management not as partners to be trusted, but as adversaries to be coerced. While it can generate quick returns for the activists, it is often destructive to the sustainable, long-term shareholder value that Buffett's method is designed to create. The final direct financial connection that ties all of this together is Buffett's concept of look-through earnings. To truly understand the compounding power of a portfolio built on trust, you have to look beyond the dividends you receive. The true earnings power of your investment is not just the cash that is paid out to you, but also the profits that are retained and reinvested by the trustworthy managers of the companies you own. These are your look-through earnings. Let's say you own a share of a company that earns $10 per share. The company pays out $2 as a dividend and retains the other $8 to reinvest back into the business. A short-sighted investor might only focus on the $2 dividend, but a true owner investor understands that the other $8 also belong to them. The critical question is, what happens to that $8? If the company is run by mediocre or untrustworthy management, that $8 might be wasted on a dumb acquisition or inefficient operations, earning a low rate of return. In that case, you would have been better off if they had paid it all out to you as a dividend. But if that $8 is retained by an honest and able manager, like the ones Buffett partners with, it will be reinvested at a very high rate of return, say 20%. That $8 will become $9.60 of new value for you by the next year. This is the hidden engine of compounding. A dollar retained and reinvested by a brilliant, trustworthy manager is worth far more to you in the long run than a dollar in your own pocket, because they can compound it at a rate you are unlikely to achieve on your own. When you build a portfolio of companies run by people you trust to be master capital allocators, your wealth is not just growing from the dividends you see, it is compounding powerfully under the surface, driven by the retained earnings that are being expertly reinvested on your behalf. This is the ultimate financial prize for making integrity your non-negotiable first principle. It is the key to true capital preservation and the foundation of all great long-term investing. You have just spent this time investing in a mental tool that 99% of market participants will never acquire. It is the integrity filter. It is the simple, profound understanding that the character of the people you partner with is the single most important variable in the equation of wealth. You now know how to look beyond the seductive numbers and the charismatic stories to see the reality of who is stewarding your capital. You have a framework for shielding your portfolio from the catastrophic losses that inevitably arise from partnering with bad actors, and for identifying the rare, high-integrity leaders who can compound your wealth safely for decades. You have taken a massive step away from the frantic speculation of the crowd and toward the disciplined, rational process of a true business owner. But it is crucial to understand that this powerful filter is one critical node in a larger network of mental models. Warren Buffett's incredible success is not the result of a single trick. It is the product of a latticework of interconnected principles. The integrity filter tells you who to partner with. It is the essential first step that eliminates the vast majority of potential investments and protects you from disaster. But to build true generational wealth, this model must be connected to others. It must be linked to the models that tell you what a great business looks like, and the models that tell you what price to pay for it. Mastering the Model SLE Who is about portfolio protection. Mastering the Model SLE What and the Model SLE When is about generating extraordinary returns. You have built the foundation, but the skyscraper is yet to be constructed. The video that is now on your screen is not just another piece of content. It is the next piece of the map. It is the link that connects the principle of management integrity to the hard-edged financial analysis of competitive advantage and intrinsic value. It takes the qualitative judgment you have just mastered and fuses it with the quantitative discipline required for superior stock picking. It is the bridge between assessing the jockey and evaluating the horse. What you have learned here today is how to avoid losing the race before it even begins. What that video offers is the knowledge of how to pick the horse that is destined to win. Amateurs in any field collect a series of disconnected tactics. Professionals, the ones who achieve lasting success, build a complete, integrated system. The choice of whether to click is not just about watching another video. It is the choice between being an amateur and becoming a professional. It is a decision to continue your ascent, to complete your mental arsenal, and to build a truly unbreakable financial future. The next step is right there. Take it.